So in the last session, we were discussing about how to do an indirect method cash flow. Now here we are going to do a problem which covers all the areas like operation cash flow, financial cash flow, and investing cash flows. Okay. Now let's see this question and what all information is provided here. Dice Corporation consolidated balance sheet account for December 31st, year 6 and year 5 is given. Information relating to year 6 activities on the left. Now, let's go through the balance sheet items. Cash, we have current investments, AR, inventory, prepaid expenses, equity method investment. That's one thing we you need to look into. Then plant assets, accumulated depreciation, goodwill. Then on the payment side, liability side, accounts payable, interest payable, income tax payable, current debt, then deferred taxes, common stock issued, additional paid in capital, and retained earnings. Now, what are the adjustments coming here? Cash dividend of 240,000 were declared and paid on year 6. Okay. Then the accounts receivable balance as of the beginning of the year 6 were net of allowance of credit losses of 50,000 and 60,000 respectively. That is write off 40,000 of accounts receivable during year 6. Then current investment consists of treasury bills, which is maturing on 6th June. Second. So, hi guys, Indu and Grace. So we were reading the questions. Just we completed this balance sheet items like cash investments and all this. So out of this, very weird one or different one is the equity method investment, and all other things are normal things. Then we were reading the adjustments for the cash flow. Okay. Now, so here the additional information is cash dividend of 240,000 were given, declared and paid in year 6. Then accounts receivable is actually the net of amount what they show here. Then current investment consists of treasury bills maturing on 6th of June. So current investments in treasury bills means where it comes. It's under current assets category, right?
Yeah.
Then equipments costing 400,000 and having a carrying amount of 140,000 was sold on year 6 for 150,000 in cash. Then additional plant purchase in the year 6 for cash. So additional plant, how much money they paid to purchase, they haven't given, which we have to calculate. Then DICE interest, DICE accounts for its interest in the Thrice Corporation under the equity method. Its equity in the Thrice year 6 earnings was 25,000. During year 6, DICE received a 10,000 cash dividend from Thrice. At the end of the year 6, DICE sold part of the investments in Thrice for 135,000 in cash. Significant influence over Thrice was not lost as a result of the sale. Then the provision of year 6 income tax was 210,000. Then 10,000 shares of common stock were issued in year 6 for $22 per share. Now, so to start with cash flow, you can see the Excel sheet, right?
Yes.
Direct method. So you start your cash flow, operating cash flow. Cash flow. Then what is the order? Financing or investing?
Investing.
Okay.
No, financing. No, investing.
Even I get confused, so I don't blame you guys. Okay, just a second. Because that order is important, investing then financing. Okay. Then 5, 6. Okay. To start with the operating cash flow, what do you need to have?
Net profit.
Net profit. So do we have the net profit in the question?
Please go back to question.
Do you have the net profits here?
We have retained earnings.
Yeah. You have net. We don't have net profit. Correct.
Mm.
So what we should do now? How to get net profit? How to start the question?
Mm.
No idea. From retained earnings, right? So when you make the profit in year 5, what do? You will add your profit to the retained earnings. Correct. So
Yeah.
from year 6, the balance will become year 5. The balance will become year 6 balance with the new profit. Correct. So when you subtract this from this, you should get the current year net profit. Correct. Am I right?
Yeah.
But what
Yeah.
happens here? We declared a dividend of 240 also, right?
Yeah.
So when you pay dividend, from where it goes? From the retained earnings.
Yeah.
Correct. So working net profit. So what is the opening retained earnings? Opening retained is 170,000. Correct.
Yes.
And what is the dividend paid?
240.
240,000. Correct.
Yeah.
So ideally, the balance should have been, sorry, how much? 90,000, right?
Yeah.
But what is our current retained earnings?
620, I think.
Right. So dividend paid, opening retained earnings minus dividend will give you closing retained earnings. Correct. But
Yeah.
what is your closing retained earnings?
620,000.
Correct. So
Yeah.
620,000 is including this negative. Correct.
Yeah.
So your total retained earnings was net profit was 690. Got it? Logic is this. This is there, and the dividend you paid. Then you have your net profit when you add, which should give you your closing retained earnings. Correct?
Yeah.
Got the logic? So 690 is the 690 is the net profit. All good?
Mm.
Because to find out the closing retained earnings, the formula is operating retained earnings plus dividend minus dividend plus current year profit. Clear?
Yeah.
Okay. Now we bring in the net profit here. Okay, this is starting. So we address the first adjustment. Clear? Okay.
Yes.
Then coming to the accounts receivable balance at the beginning of the year where 50,000 and 60,000 net of allowances. Respectively, the DICE wrote of 40,000 of accounts receivable during the year 6. Now, when you have the accounts receivable, which is net off, then what will happen in the case of net off? Any write-off, we are writing off from the allowances. So what happens? The accounts receivable will not change. Clear?
Yeah.
Any doubt on that? Anybody? All good, right? Okay. So let's. So here, next one, what you are going to take. Let's put this in the next sheet. Oh, no. Next one is
Even though it is net of this thing, wouldn't it still affect the accounts receivable?
it will affect the accounts receivable, but here the balances it will not change. Got it?
Because it's shown there net, no? So it should be
Yeah.
including the allowance,
Net of
right?
allowances for credit losses is 50,000. Okay.
Okay.
And respectively, that is wrote of 40,000. So when you write of 40,000 from credit loss allowance, so the same 40,000 will go from receivables also, right? When you are writing
Yeah.
off the bad debt, you remove the same amount from the allowance and from the receivables. So net effect is zero. So this balance doesn't change because this is a net amount.
Okay.
Got it?
Okay. Yeah.
Yeah. Then comes changes in working capital we are going to take. So what happens to current investments? It was zero, now it increased, right?
Yeah.
So now that means we have a current invest cash inflow or outflow?
Outflow.
Outflow. So minus 300,000. Okay. Then comes the accounts receivable. Before it was 510, now it's 480.
Outflow.
What means? That means cash inflow, right? Right. See, before it was
Yeah, inflow, sorry.
510 receivables. Now it reduced. That means we collected 30,000.
Collected money.
Yeah. So that's fine. Minus. Okay. Then going to the inventory, what happened? Inventory increased by 80,000, right? So is it a cash inflow or outflow?
Inventory what?
Increased.
Increased. So you bought more inventory. So cash
Yeah.
outflow.
Cash outflow. So cash outflow is minus 80,000. Okay. Then prepaid expenses was 20,000. Now it became 15,000. So paid is you use the money, right?
Yeah.
So kind of cash inflow, 5,000. Okay. Then comes equity method. This is all different level of adjustments we have. Then we are going to the okay. Then we are going to the AP side. AP. What happened? Before it was 720, now it is 825. That means cash inflow or outflow?
Inflow.
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 Okay. 5,000. Then comes interest payable, which increased. Correct.
So it is payable. Yeah.
That means payable increase means you receive more money. Right. Just like the AP.
Yeah.
The concept is same, right? So you received additional 5,000. Correct.
Mm.
Which means, see, the idea is you were supposed to pay 10,000, but you didn't pay 10,000. You are now having 15,000 payable. That means that additional 5,000 is with you.
Yeah.
Okay. Then coming to income tax payable, we'll look into it. Then current debt. Okay. What happened? Current debt increased. Correct.
Yeah.
So current debt. How much is that? 325,000 cash inflow. Okay. Because it is current debt, we are not taking it into financing activity. Got it?
Yeah.
Yeah. Before tax also we'll look at the end. Okay. Now going to the next adjustment. This is also done. Now current investments. Okay, this is also done, right? Which is maturing in the current period. Then we have next the equipments. Equipment costing 400,000 and having a carrying amount of 140,000 was sold on January 1st, year 6 for 150,000 in cash. Okay, so let's go to the plant and plant. What is the opening? 100,000, 1 million, and closing is 1,730,000. Correct.
Mhm.
Then accumulated depreciation. What is the opening? 450,000. And here 180,000.
180.
Now what happens here? It says equipment costing 400,000 and having a carrying amount of 140,000 was sold on January 1st. That means from this, ideally sold asset, correct? Minus
Yeah.
400,000. That's the cost. So how much we will reduce from
Yeah.
the accumulated depreciation?
Mm,
See, when you're selling an asset, you have to remove that particular asset's cost as well as the accumulated depreciation also from your books, correct?
yeah.
Now, here they have given the carrying amount is 140. That means 400,000 minus 140. 140 is the carrying amount, correct? So that means
Yeah.
260 is the accumulated depreciation minus
Yeah.
260,000, correct? Now, so in this transaction, one more thing is there. 260, okay, 140 was the carrying amount, but you sold it for 150, correct? Yeah,
Mm,
150 you
yeah.
sold it. So you have a cash profit of 10,000, right?
Yeah.
So this is the profit, and there is a cash flow of how much? 150,000, correct?
Yeah.
Now, regarding the sales itself, we have two things to do. One is this 10,000 profit is not our operational profit, correct?
Yeah.
Which we have to remove from our books. Clear? Which we have to
Yeah.
remove from here our operational activity, correct?
Yeah.
Profit on sale of fixed asset. It was 10,000, correct? Which was added to your net profit before. Now you have to remove it. Clear?
Yeah.
Got it. Then we got some money, sale of fixed asset. How much it was? 150,000, which you
Mm,
received cash.
yeah.
Correct. It's a cash inflow. All good?
Yeah.
Now, so that two part is done. Now we need to figure out how much is the new purchase of asset and how much is the new depreciation this year. Clear? Because here
Yeah.
in the cash flow, the indirect method, what we have to do is first add back non-cash items. Okay. And less items from other tab. Yeah. Okay. So this depreciation is a non-cash item, correct? But we don't know
Yeah.
how much is the total depreciation. Now, so balance, what is the balance now? 190. But what is the current balance you are having now? 480. Correct.
480.
So
Yeah.
that means after selling this particular asset, they were supposed to have only 190 as their accumulated depreciation. But how much we have? 480. That means what is the new depreciation we have provided? 290. Clear?
290. Yeah.
Right. So 290 is what you're going to
Add
add,
back.
add back. Then coming to the asset purchase. So here also same scenario. After selling this 400,000 asset, you should have only 600,000 assets with you. Correct.
Yeah.
But how much you are having now is 1.7 million you are having. That means this is your purchase. Clear?
Yeah.
So purchase of fixed asset will go under which category?
Investing.
Investing. Purchase fixed asset. It's minus because it's cash outflow. Right.
Yeah.
Now, so this is also done. Now, coming to the DICE account for its interest in price corporation under the equity method. Its equity in Thrice year 6 earnings were 25,000. During year 6, Thrice received 10,000 cash dividend from Thrice. Okay. Now, here there are a few things to see. One is this 25,000, the earnings on the Thrice Corporation. Did we discuss about consolidation and all those things? Equity method of accounting and all? No, right?
Equity. I
Okay. I'll
think so.
just give you a brief on that. Now, if you're having 50 percentage or more voting rights, okay, in a company, this is the holding. This is so more than 50 percentage holding you're having on another company, you call it a subsidiary, right?
Yeah.
Correct? Then you have to do is consolidation, right?
Yeah.
And more than 20 to 50 percentage voting, then you will have to do either fair value option or equity method. Okay.
Okay.
If you have less than 20 percentage, then you'll be using fair value. Okay. I'll
Yeah.
give you scenarios. So here in consolidation, what we do is normally, for example, you're having 90% share in the other company or even 51% in the other company. What do you do? 100% of the subsidiaries, assets and liabilities you'll take into your books. You merge it together. Clear? This is how the consolidation works.
Yeah.
Here you have the control of the other company. Okay. Here, especially in the UAE's landscape, even if you have 1% share, also sometimes you have the control because there is a local partner. He's just in the paper only. Got it.
Mm-hmm.
But you are having the ultimate control. Then you should consolidate in your books. Clear?
Yeah.
Okay. Now, so here there is a control more than 50% voting. Then comes a 20 to 50%. That is, we call it a significant influence. Influence. Okay.
Yeah.
Significant influence means you can't take independently decision, but you can collaborate with some other people and take decision, right? You're having 20% shares. I'm having 20. For example, Grace is having 20% share. That means we total have 60% shares to take decision. Clear?
Mm-hmm.
So that's a significant influence. Now, less than 20% shares. This case is where, like, for example, you are investing in some Google shares or some shares, a small amount of money. Then you do the valuation on fair value method. Clear?
Yeah.
That means you might have 5 shares in your hand. You will go and check in the stock market or what is the rate. You multiply, you get the total investment. Correct. That's the fair value option. Now, in equity method, what happens is it's a simple accounting method. Equity method is normally everybody does when they invest in some other companies. Like for example, I'm starting a cafeteria. Okay, maybe a cafe. That's enough. Okay, I'm having a cafeteria. Now, I'm starting the business for 200,000. It's the total investment. 200,000 is the capital total. Okay. And I am asking Betsy to have a 25% share in my company. Okay. 25% share
Okay.
is with Betsy. Now, how much percentage will be that? So Betsy will be investing 50,000. Clear? Okay. After first year, I made a profit of 100,000 dirhams. Okay. And Betsy also know that I
Yeah.
made a profit of 100,000 dirhams. Okay.
Mhm.
After first year, if Betsy want her money back, how much money she will ask me? Will
Uh,
she go with 50,000 or she will ask for more?
More.
More. How much more?
25% of 100,000.
25% of 100,000. Correct. So you were supposed to get this much amount. Correct.
Yeah.
So how this happened? Because in your P&L, you have shown this 25,000 should come from Nadeem. Okay.
Mhm.
So this 25,000 you will add in your books as profit share in equity based investment. 25,000. Clear?
Yeah.
Okay. Yeah. So now going back to this question. So what happened? This 25,000 is that 25,000. Got it?
Okay.
So this will be shown in your P&L. But my question is, did you receive this 25,000?
Can you go back to the question?
Okay. See, here you don't receive this money. In this example also, did you receive this 25,000? No.
No.
But in your books, you written that 25,000 should come from Nadeem. There's a profit share. So
Yeah.
in your balance sheet, your investment total will be 75,000. Clear?
Yeah.
And the entry will be investment account debtor to profit on equity method. Okay. So 25,000 and here. So this will be balance sheet item and this will be P&L item. Clear? Now more clarity?
Yeah.
Now, so what happens
Yeah.
here? This 25,000 profit you didn't receive. This is basically an accrual entry, correct? Okay. So this 25,000 you have to remove from your profit. Clear?
Yeah.
Got it. Okay. Now what happened? I gave you dividend for 10,000 dirhams. I'm giving you dividend 10,000 dirhams. So when you get the dividend, your entry will be, okay, cash account debtor to investment 10,000. This is balance sheet and this is also balance sheet. Clear? So this dividend is not affecting your P&L. Clear?
Yeah.
Your investment will become how much? Because now after receiving the dividend, Betsy is asking for her money, then I will pay her only 65,000. Got it?
Yeah.
Okay. So now this dividend, in this question also we have this 10,000 as a dividend. Going to the dividend part. So you receive the dividend. So dividend received will be here. Dividend received is 10,000. Clear? Got it?
Yeah.
Okay. Now going to the next part, the investment. Here, Tice sold part of the investment in Thrice for 135,000 in cash. Significant influence over the Thrice was not lost. That means he is still holding more than 20% shares in the other company. Clear?
Mm.
Okay. Now, let's go to the investment. What was the opening balance? 300,000. Okay. Let's take this as 300,000. Let's put this 25,000 to this. Okay. Now, sorry, 300,000 was the opening capital. After sales, it became 215. Correct.
Yeah.
So, okay. So 300 and this share will come there. Correct. Net, right?
Mm-hmm.
Profit and dividend. Correct. This will happen in this account, right? 25,000 is the profit share minus 7,000 dividend. So to 15,000 will add to his investment. Correct.
Yeah.
So ideally, his balance of investment was supposed to be how much? 315. Correct.
Yeah.
Uh, now, but what happened here? He says he sold his investment for 135,000, but we don't know what is the
Yeah.
cost. Okay. Now, this was supposed to be the balance, but what is the current balance now?
200 something.
Yes. Closing balance is how much? 250. So that means what is the cost of the cost of investment sold?
100?
100,000. Correct.
Yeah.
Okay. So 100,000 is the cost of the investment they sold. So how much profit they made?
35,000.
Yeah. So 35,000 is the profit they made. So that profit is where? It is in the P&L.
P&L.
Correct. Yeah.
Yeah.
Profit on sale of investment. 35,000 you have to remove. Correct.
Yeah.
And where you will show this 35,000? Sale of investment. Correct. But you will show how much?
135,000.
135,000. Clear? So the whole adjustment is done. Okay. Plant, this is all done. Equipment, done. Then goodwill. What happened to goodwill? It was 100,000. Now it became 90,000. That means the amortization is 10,000. Correct.
Yeah.
Amortize goodwill. That we will add back 10,000. Clear?
Yeah.
Then goodwill is also done. Then deferred taxes. Okay. Next, coming to the tax loss, we'll look into. Okay. Return earnings is also done. Okay. Now, common stock. 10,000 shares of common stock were issued on year 6 for $22. So, how much is common stock? $10 is the par value, right? So, $12
Yeah.
is the additional paid in capital. So,
Yeah.
even if you look here, invest financing, issue of shares, actually 10,000 into 22. $10. Yellow. I didn't see. Door not on track. Chal. Door. Front door. Fish tank in it. Near to fish tank. Oh. Sorry, guys. So 220,000. Even if you take here also, you get the same answer. Okay. 800 minus 700, that is 100,000. 370 minus 250, 120. So that is 220 is the total. Clear?
Okay.
Okay. Now, coming to the income tax part. So, income tax payable was 30,000. Income tax payable now became 20,000. That means you paid 10,000, right?
10,000. Yeah.
Yeah. So, income tax paid. Right, you paid. So, 10,000 you paid. That means that is 10,000 cash outflow. Correct.
Yeah.
Then deferred tax 300 it was, now it became 250. That means 50,000 you paid. Correct.
Yeah.
Deferred tax minus 50,000. Then provision for year 6 income tax was 210. So that provision we have to remove, right? Second provision, income tax. That is 210. So that 210 you will have to add back, right? Now let's see